So I've been thinking a little bit about my portfolio and how I've allocated my resources there. And I know that at the beginning of this series of Invest With Me, where I showed you guys my Wealthsimple portfolio, I did mention that I was trying to switch it over to a more growth stock oriented portfolio. And I'm really heavily considering transitioning all my dividend stocks into this one growth stock that will end up making around 30% to 50% of my Wealthsimple Trade portfolio. And the fact that there's zero commission fees, it makes it super easy to rebalance my portfolio in Wealthsimple Trade. So if you guys want to sign up for that and just have that flexibility, links are down below in the description. But first, taking a bit of a look at the set over here on camera, it's a bit messy, so let's clean that up first. So that's a little bit better. What's up, you guys? Welcome back to my channel. My name is Daniel, and here on this channel, we talk about growth stock investing with a focus in the Canadian markets. And in today's video, I'll be talking about one of my favorite stocks that are in the telehealth space, but it's not just a telehealth stock. And this company is none other than WELL Health Technologies. And if you've been here on my channel, you'll notice that I do talk quite a bit about WELL Health Technologies, CloudMD, and a bit of Jack Nathan Health. But I want to focus on WELL Health Technologies today and why I'm considering making it around 30 to 50% of my Wealthsimple Trade portfolio. I think that there's good long-term future growth ahead, and I'll be walking you through their business and why I think this is a huge opportunity, even though the prices have run up by about 380% year to date. So first off, I'll be breaking down all the business units that they have, as well as going over a few quotes from the Q3 earnings call that I think are very key. Secondly, we're going to be going over the total addressable market only within Canada to see how much more room they have to grow. Third, I'll be talking about telemedicine in specific and just how this industry will play out after the pandemic is over. And ultimately, that's probably why we saw a bit of a sell-off when the Pfizer vaccine was announced as 90% effective. Fourthly, I'll be talking about Q3 earnings and what are some key numbers from there. And there's one very key number there that will actually link into the fifth thing that we're talking about, which is projections for their growth in the future. And in this projection, I'll be showing you what WELL Health might look like in 5 years, based on a certain growth metric that I like to take a look at for all my growth stocks. And lastly, I'll be wrapping up with a conclusion, so if you want to skip right there for the TLDR, go ahead. It's in the timestamps down below in the description. Let's get started with all the different business units they have. In WELL Health, you could say they have anywhere from 7 to 8 business units, depending on how you want to break it down. But I'll be breaking it down into 8 units. So the first business unit that they have is their clinic network. Ever since WELL Health started as a business, they've been buying up clinics left and right. To date, they have just over 20 clinics that are under their control as a full 100% ownership, and they have partial stakes in other clinics as well. And WELL Health is in the top 5 largest clinic networks within Canada, and this happened in the span of 2 to 3 years. The second business unit that they have is telemedicine, and in March they launched the Virtual Clinic Plus. And ever since then, they acquired another company called Insig, which brought them telehealth, which is also another telemedicine platform. So going forward, WELL is actually going to be putting Virtual Clinic Plus under telehealth, and they're going to be operating under the telehealth brand. The third business unit they have is digital apps. And I think of this as the equivalent of Google Play Store or Apple App Store for the health world. So this allows software companies to come in and write different digital apps that help handle healthcare information. The fourth business unit that they have is WELL EMR. And WELL EMR is basically their electronic medical record system where all of the patient data lies in an electronic form. Rather than those rows and rows of filing cabinets that you guys see at your doctor's offices, those are replaced by digital copies on a database. This is the bread and butter of WELL's digital technology where all the information is stored here. In digital apps, they connect to the WELL EMR system and pull data for doctors to see. The fifth business unit they have is WELL Allied Health, and this includes physios, chiros, occupational therapists, dietitians, sleep doctors, as well as mental health. The sixth business unit they have is cybersecurity, and this is super key to the core of WELL's business because a lot of their technology that they're making right now is digital technology which holds information. And we know that privacy is a huge thing for health data. So they need top-notch cybersecurity to couple with their digital assets in order to make the most secure platform for people's data. The last thing that you want is to have your health data stolen by some sort of hacker group. So cybersecurity is super important for WELL Health Technologies as they're creating a digital transformation in healthcare. The The second last aspect of Well's business is billing. And they recently acquired a company called Doctor Care, which is going to help them branch out into helping doctors and clinics do medical billing. And the last business unit that they have is their US expansion. And I put this in a separate category because what they've done so far with their other business units target the Canadian market only. Things can't exactly port apples to apples over to the US market because there are different rules and regulations. So that's why I put this in an 8th business unit. Well Health's business is actually fueled by 2 growth engines, and this is in their clinic space as well as telehealth. The rest of the business units support these 2 patient-facing business units with digital transformations. When Well Health started out, they initially saw that there was a lot of unlocked value in clinics that they could unlock with digital transformations. Not only would this make them a more profitable company, this would also benefit the patients as well. They started buying clinics left and right and using different digital transformations to bring efficiencies to these operations and see if their thesis was correct. And ultimately it was. They were buying clinics with sub 20% profit margins, some that were even 5 to 10% profit margins only, and they've turned this into an entire business that generates gross profit margins of 40%. And they're not slowing down at all. So now let me turn over to the Q3 earnings call, and I have a couple quotes that I think are very key for us as investors to know about Well's business and how management is thinking. The first quote says, "What I'm conveying here is that each business unit that we've invested in, we believe, on a standalone basis can be bigger than Well is today." So CEO Hamad believes that each individual business unit that I mentioned earlier can be bigger than Well Health is today. Well Health has about 6 business units according to the CEO. I broke it down into 8 to give us a bit more of a granular picture of what's actually in Well Health as a company. So if we were saying each of these business units were going to be larger than Well is today, and Well's at a $1.2 billion market cap, we could see that Well Health could easily be worth anywhere from $6 to $8 billion in the future. That is, if each business unit could command the same multiple that Well Health is commanding today. The second quote that I have for you guys here is how management views all the M&A activity that's happening in the digital health space. But you know what's really unique, and it's interesting because people call us a telehealth stock, and we're really not. I mean, you've never heard me say that we're a telehealth company. I've never said it before. I will never say it. We're not an EMR company. We're not a clinic company. We're a company that's investing in the future of healthcare. And in our view, that takes a variety of forms, and that is why the business unit structure makes so much sense. We think cybersecurity is as important to play on the future of healthcare as is clinic transformation because of the incredible importance of the most valuable data in the world going online. All these business units and all these themes are enhanced by digital. And that's really what we're about. What we saw is a monumental historic opportunity where the biggest sector in most services economies has not digitized yet. And we thought that was too good of an opportunity to pass up to be involved in those tailwinds and add value to those opportunities. So that's just a long way of saying a little bit, but not really. We're not worried about assets being bid up. We're going to continue to stay our course. So the M&A activity around the digital health space is really hot in Canada right now, where companies are going for earnings multiples of up to 6 to 10 times. And this is an extreme premium to pay for small companies that may not have a proven out business. But Well Health's management, they're not worried about these assets being bid up like crazy, and they're not buying into these businesses that are commanding crazy multiples. They're being very strategic and disciplined in how they acquire companies, and not just going after the shiny object, but to see if it actually makes sense with their current business units to create some sort of great synergy that improves the gross margins of all their businesses. And essentially how Well is managing their business units is that they're using a decentralized model. They allow each individual business unit to be run by its leader and ultimately drive the direction of it. And the only centralized things about all these business units is capital allocation. So they have a central Well management team which looks at all 6 or 8 of the business units and sees how they're doing. And then based on how each one's doing and the growth numbers of each one, they do their capital allocation from top down. The ones that are really driving growth, they'll accelerate that growth by dumping cash into there, whereas the ones that are a little bit more steady, they won't be throwing a ton of money into like marketing activity, for example. Let's talk about the total addressable market that Well Health has in Canada alone. And this will show you how small Well is to the Canadian population and how much more they have to grow. And if they can grow this much in Canada, then the States, really the sky's the limit there. So I found some numbers from 2018 where $27.4 billion were paid out to clinics. And if we look at Well Health's Q3 earnings, they had about $9.6 million in clinic revenue. And if we take these Q3 numbers, multiply it by 4 to get a full year's picture of how much revenue their clinics will be generated, and weigh it against a 2018 number of $27.4 billion, this represents 0.14% of the Canadian clinic payouts. So Well Health is still an extremely small portion of the pie when it comes to Canadian clinic payouts by the government. And right now, the clinics in Canada are very fragmented. They're all one-off or maybe small little chains out there. And Well Health being one of the biggest clinic owners out there, they can continue to grow and possibly become a dominating player in the healthcare clinic space. And the fact that Well Health stock continues to shoot to the moon, this is actually good for management because they can continue to raise capital off the back of shareholders. And some of you guys might look at this as a negative point, but I see it as a positive point. As long as Well Health shares continue to rise rapidly, each time Well Health can raise more and more cash without diluting shareholders as much. And if they can raise more cash, this allows them to accelerate their business growth through mergers and acquisitions like acquiring clinics. When they acquire those clinics, they're not planning to just run that as a clinic business. They're also bringing those physicians onto their telemedicine platform and creating an omnichannel experience for their patients. And this brings us to our next section, which is why I think telemedicine is not going away after the pandemic. And the CEO also addressed this in the Q3 earnings call, which I'll be mentioning a few things from him in this section. First off, those of you who look at telemedicine and have doubts that doctors can actually diagnose things over telemedicine are completely wrong. Here are a list of health problems that telemedicine can address: nasal congestion, sore throat, allergies, urinary infections, sexually transmitted infections, dermatological issues, muscular and joint pain, anxiety, depression, insomnia, travel, and nutritional health. Another big thing that telemedicine actually addresses is follow-up appointments. So oftentimes people go to the doctors not just once, but multiple times for a certain health issue. And the second, third, and nth appointment are typically just checkups on how the patient is doing. There isn't some sort of physical scan that the doctor has to do. It's more so asking how they're doing and if they need their prescription refilled. So these appointments can actually be shifted over to the telemedicine platform instead of having the patient needing to book off time from work to go into the doctor's office and see them. Telemedicine has been a hot topic for Well Health, and let me explain to you why and now I think that telemedicine will still stick around even after the pandemic is over. So first off, when we look at the average physician age, we see that it's around the age of 50. And 50 is not really a young age to me. And I think that a lot of these doctors in the next 10 to 20 years, they're looking to retire. As well as we know that the baby boomers are actually shifting from the middle-aged people to elderly people. And they're going to put a huge strain on the healthcare system. So with doctors looking to retire, and some of them possibly even retiring earlier than the age of 65 because they're pretty well off, and also more elderly people in the future, we're going to see doctor wait times balloon quite a bit. And I think that telemedicine is one of the solutions to help Canada and the healthcare system. So for example, a doctor who's retired could actually keep his license and continue working on the telemedicine platform because he can choose to work maybe 1 or 2 times a week, and the rest of the time he could go golfing. So this will allow doctors to come back into the workforce and work a couple times a day while also being able to go off on the side and do things that they couldn't do while they were working a full-time job. And how I see this telemedicine platform is basically like an Uber, but for doctors. Doctors can choose to set their schedule on this telemedicine platform. Some of them are workaholics and maybe will work till 9 p.m. at night, while others have a family balanced lifestyle where they only want to work from 9 to 5. And also doctors with young kids now can also choose to possibly work 3 days in the office and 2 days at home on telemedicine. So I think that we can see a bigger shift towards telemedicine as A, it's easier for doctors, allows them more flexibility, and B, it's also easier on clients or patients that they can choose to take their appointment, maybe in a meeting room at work, or just going home to get their kids and doing a telemedicine appointment there. So telemedicine really helps free up the average person's schedule and also the doctor's schedule. One other fact is that telemedicine appointments cost the government less than in-person doctor's appointments. Because the in-person doctor's appointments, they have to cover rent, cover different sort of materials like cotton swabs or certain doctor tools, as well as they have to pay other staff. But telemedicine is a lot less overhead, so they charge a lot less. And when the government sees this as a way to lower their budget on healthcare, as well as taxpayers notice this, this telemedicine platform is going to be pushed a lot harder by the government side. The CEO of Well Health also stated that he expects around 40 to 50% of appointments to be delivered online after the pandemic. This is because many doctor's appointments are just simple questions that people want to get answered, and a lot of these things can be done over the phone. So the term that he's coined for this omnichannel delivery of healthcare is bricks and clicks. So you go into the in-person doctor's appointment for any sort of physical examination, and all the other follow-ups can be done online through a click of a button. Now let's turn our attention over to Q3 earnings to understand a bit more about this business and put these numbers into our model, which gives us some sort of an idea of where Well Health is heading. So to start off, the revenues for Q3 was $12.2 million, which represented an increase of 50% year over year. The gross profit rose from $2.9 million to $5 million, representing an increase of 75% year over year. So you can see that the gross profits were growing faster than the revenue, meaning that the gross margin also grew a bit. The gross margin now sits at 41.2%, which is the highest that it's ever been in the history of Well Health. The adjusted EBITDA is a measure that Well Health likes to take in terms of how they can measure their business and the success of it, but this is not a GAAP financial metric. So if you want to understand adjusted EBITDA and what it actually covers, you can go to the earnings report. But their adjusted EBITDA was negative $153,000 for this quarter. And the only reason that it was negative was because they heavily pushed their apps.health as well as the Virtual Clinic Plus platform through marketing. If they didn't push as much dollars into marketing, they would have had a positive adjusted EBITDA, which is a good sign. If we compare this to the previous year's quarter in Q3 2019, the adjusted EBITDA was $513,000. So we can see that they brought down that adjusted EBITDA loss to only $153,000, and next year I expect them to have a positive adjusted EBITDA. If we break up their $12.2 million revenue into clinical versus telemedicine, we can see that on the clinic side, they had about $9.667 million in clinical revenue. This represents a 17% quarter-over-quarter growth, as well as a 34% year-over-year growth. The quarter-over-quarter growth was mainly due to the reopening of BC having a number of in-person visits rebound. However, there was a bit of a warning saying that the second wave of COVID-19 will probably end up slowing down the clinic revenue in the next quarter, and we may even see it negative quarter-over-quarter, but it should be positive year-over-year. On the digital services revenue side, they saw an increase of 149% year over year. And this is compared to $1 million in Q3 of 2019 to $2.5 million in Q3 2020. So it's clear that they're rapidly ramping up the digital services revenue through acquisition as well as just bringing new synergies between their business units. If we take a look at the net loss for this quarter, it was $3.6 million compared to $4.8 million a year ago. So we can see that the net losses are closing in and maybe they'll squeak out a profit in the next coming years. One interesting metric that's not really shown on the financial statements but was mentioned by the CEO is the annual run rate. And this is important because it shows us how much revenue they expect to generate with all their businesses at the point in time which the earnings call was released. So this is not at the end of Q3, but this is as of November 12th. Based on all the acquisitions that they've done, they had an annual run rate of $68 million. And we know for Q3, if we take it based off of that revenue of $12.2 million, the annual run rate would be somewhere around $50 million. So between September 30th and November 12th, they've increased their annual run rate by $18 million through acquisitions. Some other interesting metrics were that they saw a total of 236,000 patient visits, and this was split across telehealth as well as in-person. We saw 120,000 in telehealth, and they also saw another 115,000 in-person visits. And if we take the number of in-person visits and divide it by the total clinic revenue, we can see that on average they earn about $83 per visit. It's a little bit trickier to break down how much revenue they earn from each telehealth visit because their digital service revenue is not broken down into telehealth versus other things like cybersecurity or other digital services like doctor billing. The last thing from Q3 earnings I want to point out is how they're planning to grow their business in the future. And there's 3 points that the CEO addressed and that we as investors should pay attention to. This is what management is thinking going forward. So Well's goals for the foreseeable future are to achieve organic revenue growth in its operating businesses, meaning that they're trying to wean off of using marketing dollars to bring in revenue, but rather have customers return organically or having things like word of mouth spread their services. The second thing they want to do is to continue to follow a disciplined acquisition and capital allocation strategy. So this is allocating capital amongst their 6 business units strategically, also keeping disciplined in their acquisitions and not succumbing to FOMO and trying to buy businesses left and right only because other people are doing so. They're going to look at the economics of the business that they're purchasing and see if it actually makes sense for the price that they're paying. And the third thing that they plan to do is to increase market share and awareness of its digital health initiatives. So these are things like promoting apps.health and getting more clinics using their EMR system. Now let's jump over to this quick Google sheet that I made, which shows projections of Well Health's revenue in the future, as well as the PS ratio. So I made two different types of projections here, where the revenue grows at around 50% year over year versus the revenue growing at 70% year over year. I think that Well Health could easily achieve a 50% growth based on the ways that their shares are trading, as well as the amount of capital that they have to deploy in mergers and acquisitions. So you can see that these numbers here along the top are in millions. So based on all of 2020, I think that they'll be able to achieve $50 million in revenue this year. Q4, based on the annual run rate of $68 million, that should give them $17 million in the next quarter. And then the past three quarters, Q3, Q2, and Q1, make up the rest of that at around $33 million. So that gives us $50 million for 2020. And the PS ratio in 2020, based on the current market cap of $1.28 billion, is 25.6, which is quite rich. But as we go down the line and watch these projections play out, based on a 50% revenue growth, we can see that it goes to 75 million, 112 million, 168 million, 253 million, and finally 380 million by 2025. And if they earn $380 million in 1 year by 2025, their PS ratio will be a measly 3.4 based on their current market cap of 1.28. Now things get a little bit more exciting when we go to the 70% growth year over year. So we can see that in 2025, they'll end up generating around $709 million in revenue if they grew at 70% year over year. This will mean a future PS ratio of 1.8 based on their current market cap of 1.28. This is under the assumption that the total number of outstanding shares does not grow for the next 5 years, as well as the current share price stays at $7.55. Of course, this is not the case, but basically if you're buying right now at today's prices of $7.55, 5 years down the road, what you paid for it, you're going to be paying a PS ratio of 1.8 or 3.4. Now there's a lot of caveats with this sort of projection, but this is a simple way that I'm looking at it right now and justifying what I'm paying for Well Health today if I were to buy at $7.55. It's very possible that we could see Well Health grow at even faster rates just because of the economies of scale. Right now, they have a balance sheet with over $100 million. This includes their previous raise of $80 million, as well as they have no long-term debt. Going forward, I'll probably make some more in-depth spreadsheets and future projections on Well Health Technologies as I continue to do my research. But for now, based on what I found, I am very convinced that this company is a great company to hold about 30 to 50% of my portfolio in for the long-term future. So in conclusion, why am I putting 30 to 50% of my portfolio in Well Health Technologies? Well, Well Health Technologies is building out an ecosystem of products that help support the medical industry. Their acquisitions that they've made, as well as any future acquisitions, will help complement their portfolio of existing businesses, and they're going to create this sort of sticky ecosystem that as clinics come in and use their products or services, they will be roped into Well Health's ecosystem because there's so many things that are interconnected. As well, with more mergers and acquisitions, the Well Health business unit as a total will become a better and better well-oiled machine. Things like having redundant roles cut when they merge and acquire new companies is ways that they can save money, as well as development times for companies that they merge and acquire are going to go down. When we look at the total addressable market, even just within Canada, Well Health is still a very small player within this whole medical system. There's a lot more room for Well Health to grow even just within Canada because of how fragmented the medical clinic business is. Not to mention, they also have the US expansion, which is going to unlock even more potential. Currently, digitization in the medical industry is still in its infancy, so there's a lot more technology that can be developed going forward. The reason why the medical industry has not seen as much technological disruption is because lives are at stake when technology is introduced. There's a lot of rules and regulations around technology and data handling in the medical space, and I know that firsthand based on my startup experience. So it's very difficult for new players to come into the space and want to be like, I want to build an app for the medical industry. There's a lot of fees that they have to pay to get certifications in order for that software to be deemed safe, as well as stand up to some sort of level of privacy. the last reason why I want to put a lot of money in Well Health is because they're debt-free. So the fact that Well Health has a lot of cash as well as no debt and a management team that knows what they're doing when it comes to mergers and acquisitions gives me a lot of confidence that they're going to be able to build this business into a multi-billion-dollar business in the future. Right now at a $1.28 billion market cap, it may seem large for a Canadian tech company, but in the grand scheme of things, looking 5-10 years down the road, I can probably see this company end up being somewhere around a $10 to $20 billion company, representing at least a 10x in my money today if I were to invest at $7.55. Yes, the stock has run up from a $300 million market cap to a $1.2 billion market cap, representing roughly around a 380% increase in one single year, but they've proven that they can grow their annual run rate even during a pandemic from around $40 million to $68 million within less than 1 year. So this business is rapidly expanding and they have a good management team, good capital. So overall, I'm happy to invest at $7.55 today and probably will be selling out of my dividend stocks in the coming weeks. Let me know your thoughts down below if you guys are investing in Well Health Technologies and whether you plan to hold Well Health for the next 5 to 10 years. If you found this video useful, leave a like down below, as well as subscribe and hit that notification bell if you want to follow my journey in investing in Well Health Technologies. I've got 2 videos up here on the screen about Well Health Technologies as well, where I've talked about them in the past. If you're interested in hearing my thoughts about Well Health previously, check those out. If you're there, I'll see you there. If not, keep up the grind and have a great day.